And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. How will the Fed's hawkish stance on tapering and potential rate hikes affect the market in 2022? Let's find out what the CEO of one of the world's largest private investment firms is telling his clients. Gerard O'Reilly is co-CEO of Dimensional Fund Advisors, one of the largest value managers in the world and a leader in converting mutual funds into ETFs. Also joining us is Nate Geraci, president of the ETF Store. Gerard, the reappointment of Jay Powell has the markets operating under the assumption that future Fed policy will now tilt towards a more hawkish stance. What, in your opinion, does this mean for stocks in 2022, and what does raising rates mean for the markets right now?
So thanks, Bob, and thanks for having me on the show. It's good to see you. You know, when you look at what the Fed is doing today, they're really telegraphing what their plans are over the next few months. And so the market is incorporating that information into prices today. So what we tell our clients is, well, let's look to the long term to see how markets have incorporated this type of information in the past. And when you look back over the past 40 years, Bob, the average monthly return on the US market has been about 1% a month. And when you look at it in months when the Fed has raised the target Fed funds rate or decreased the target Fed funds rate, it has been about 1% a month. And regardless of what the Fed has done, about 2/3 of the time, the market has gone up in months, whether it's raised or decreased the target Fed funds rate. So the Fed is telling the market what it's planning to do. The market already has priced that in. So if the Fed does what the market expects, you can expect the long pull return on markets, in my view. And that's effectively what we're telling our clients. Focus on the long term, look at the long-term data.
Yeah, that's what you guys are all about. Now, Gerard, I want you to reiterate your investment philosophy. I always ask you to do this when you're on. You're very closely aligned with index investing, but you layer over that a small cap and a value tilt. Can you explain that and what the ideology and the methodology is?
Yes, indeed, Bob. We are closely aligned with index investing. But how I like to describe ourselves is that we're systematic fundamental. And what does that mean? Well, it's not something new. That's the good news. We've been doing this for 40 years. But what it means is it takes a lot of the benefits of indexing, whether that's low cost, whether that's transparent, rules-based approach. And what it layers on top of that is a daily process, daily oversight. And that daily oversight allows us to take information from stock prices, from bond prices, to increase expected returns and manage risk, in my view, more robustly than an index approach does. So you can think about it as all the benefits of indexing, but then take that active implementation and try to add value in excess of indexing. And you're right, Bob, we do tilt to small cap and value stocks, as well as high profitability stocks. And what we're pursuing there are higher returns on behalf of our clients, because over the long pull, what we've seen is small cap value and high profitability stocks have outpaced the market by about 2 to 3 to 4 percentage points a year. So we're pursuing those higher returns on behalf of our investors.
I want to come back to that higher profitability shortly, but let me just follow up, Gerard. Small cap and small cap value have done well this year, but it's really the first outperformance in several years. So we've got this uncertainty over the Omicron variant. But what's the outlook for small cap and value in 2022? Are you basically just still stay the course? Do you think small cap and small cap value can outperform growth and big cap in 2022?
We do indeed, Bob, because when you think about the Omicron variant and you think about new news when it comes to the marketplace, it moves stocks. After it has moved stocks, people may still talk about it, but now it's old news. And so market prices are forward-looking, their predictions of the future. And again, what's known about the Omicron variant is known and already priced into stocks. So again, we look to the long pull. And over the long pull, even after years when small value has outperformed large growth, and we see this in the data, the following 12 months tend to be pretty good for small and value. You get a little bit higher than the long pull average. And that long pull average, by the way, Bob, has been about 4% or so per year for small value in excess of large growth, maybe even higher in some years. So again, we tell our clients, invest for the long term and look to the long term to inform their expectations on any given year. So we think small and value stocks are well poised to outpace the market for 2022.
You know, Nate, despite what Gerard is saying, investors, at least CNBC viewers, seem pretty obsessed with growth and have been for the last decade, really, since the Fed has been stimulating the economy. But investors are paying an awful lot of money for growth these days, for a future stream of earnings, at least for a dollar's worth. Is that going to change in 2022? Do you think, as Gerard thinks, that small cap or value may outperform?
Yeah, I don't think there's any question the overall backdrop here is growth is richly valued at this point. And especially as you start to go down the quality spectrum, look at areas like unprofitable technology companies. They're clearly overvalued at this point, and we're seeing the ramifications of that here recently in the market. I want to echo what Gerard is saying, and that certainly taking a long-term approach here is prudent, but there's a lot of confusion in the marketplace right now, and that the Omicron variant, that could have a meaningful impact on the economy if things are worse than expected. But at the same time, we have a Fed who is taking a more hawkish posture at this point in time, indicating that inflation may not be transitory. And perhaps they may look at tapering bond purchases sooner than expected and raising rates sooner than expected. In my opinion, those two things are at odds with each other, because if the variant is more of an issue than expected, clearly the Fed can't be overly aggressive in that situation. Now, you could have a unique situation where perhaps the variant is more of an issue and it does have some economic impact, but that ultimately leads to supply chain constraints. And you start seeing greater inflationary pressure even while the economy isn't doing so well. That would be a very tricky spot for the Fed to be in my opinion, probably a worst case scenario.
So that's the problem, Nate. I mean, most viewers who I talked to wrote into me, said they assumed Omicron would make the Fed more dovish, but it's turning out Omicron is making the Fed more hawkish because they're even more concerned about potential inflation because the supply chain disruptions might continue under Omicron. That's what's causing all this confusion out here. That's why people can't figure out why is the 10-year yield so low if we're going to have problems down the road. It just creates a lot of confusion. At least the viewers are totally confused right now, Nate.
No, there's no question. Now, I will say we can look at what the Fed has done over the past decade plus. Clearly, they've been supportive of the financial markets. And when you think of the one instance when they attempted to get more aggressive back in the fourth quarter of 2018, the market clearly reacted negatively and the Fed quickly reversed course. And so I think investors have this feeling that the Fed is always going to be supportive of the market. And until we see something different, I think that's probably a pretty good bet.
Yeah. Gerard, you started out the year converting several equity mutual funds into ETFs. I want to talk about your new offerings here. Now you're listing 4 fixed income ETFs and filing for 10 more equity ETFs. But this, again, is somewhat actively managed. Again, investing in bonds that you've got here, but you're trying to figure out how you can get higher expected returns, right?
That's right, and we launched and listed 4 fixed income ETFs about 3 weeks ago, Bob, and they've done well so far in terms of meeting client demand, and we have over $500 million across the 4 fixed income ETFs in the first 3 weeks or so. I think Nate made a few very good points around what's expected and unexpected. And in particular, if what's expected happens, well, then you get the expected outcome, but unexpected things may happen as well. And I will go back to the inflation point that Nate was making there. And when you think about inflation and whether you can predict it or not predict it, certainly the market over the long pull is pricing in, if you look at break-even yields, around high 2s into low 3 percentage points. But what you can't predict the unexpected, but you can plan for it. And so if market participants are worried about inflation or worried about higher interest rates or lower interest rates, you can certainly plan for it. And with inflation, it's outpace it or it's hedge it. And they're your 2 choices. What we know over the long pull is stocks and bonds have outpaced inflation. And we know that there are plenty of instruments out there like TIPS that can hedge it. Yeah. So again, right. I think there is a lot of uncertainty, but there's lots of choices for investors to plan well for 2022.
And the key, Gerard, it seems to me historically that stocks do well in periods of moderate inflation because corporations generally have pricing power and they can raise prices. The problems where I've seen is sudden inflation like in the early 1970s, beyond expectations, where corporations lose pricing power, and then you see real underperformance, inflation adjusted, right? I mean, that's why we sort of are worried about inflation getting out of control. We don't care about 2% or 3% inflation a year because we know the market's going to do well long term, equities will. But when you get sudden inflation, you lose control of pricing power. Is that a right way to look at it?
Yeah, when you get sudden inflation, certain assets may go down and certain assets go up. So, for example, if you have sudden unexpected inflation, generally what happens is that inflation-protected bonds do a lot better than real bonds, or nominal bonds, excuse me. And so, again, if you're worried about that, there's plenty of instruments out there, like an inflation-protected strategy, that can do very, very well when you have unexpectedly high inflation. And so that may impact stocks in a particular way. But as mentioned, there's plenty of strategies that do well in those environments.
Right. Inflation-protected securities haven't worked very well for many years, but they may well work well in 2022. You know, Nate, I was talking to you earlier about dimensional funds and what they were doing earlier in the year. Gerard pointed out that you had a very amusing comment about dimensional funds earlier in the year as they converted some of their funds to ETFs. Let me just read this briefly here. DFA arriving late to ETFs is like Brad Pitt walking through the door of an Oscars after party at 1 a.m. Both are immediately the center of attention, and it doesn't matter that the party is already in full swing with people dancing on the tables. This is, Nate, this is terrific and very colorful. There's only a handful of firms that could have had success in ETFs, no matter what they got involved. I think DFA is one of them. I love that quote here. But, you know, other than the nice little Valentine there, the DFA, Nate, it's not just them getting very involved. It's amazing the number of big firms, American Century, I'm thinking, even T. Rowe Price, that are becoming real powerhouses in the ETF business that weren't before.
It's amazing. And, you know, on the note of DFA, here you have a firm that launched their first ETFs in November of last year. And already they're knocking on the door of becoming a top 10 ETF issuer. It's truly remarkable. I think clearly DFA has extremely strong brand recognition. They have a very loyal advisor following. They have academically rigorous research underpinning their investment strategies. This isn't some fly-by-night operation. And I think perhaps most importantly, they've approached the market from a low-cost standpoint. When you're going to enter the ETF terror dome, so to speak, you have to come willing to do battle, and part of being willing to do battle is coming in at a low price point, and they've done that. If you look across their ETF lineup, the average expense ratio is about 23 basis points, and they have core exposure as low as 11 basis points. So I think they're a good proxy for what we're seeing across the entire ETF space. To your point, we've had firms like American Century, Harper, Janus Henderson, T. Rowe Price, Nuveen, all ramping up their ETF businesses. And I think we're going to continue to see this. These traditional mutual fund companies that have strong legacy brands wanting to deliver exposure in the format that investors are wanting, and that's ETFs.
Yeah, you know, Gerard, this is quite an aggressive little profile that you've got here with these 10 new ETFs. One thing kind of caught my eye. Two of these equity ETFs you filed for caught my eye. The International High Profitability ETF and the Emerging Markets High Profitability ETF. I'm wondering, is high profitability another factor that shows outperformance along with value and small cap? I know, of course, you know, the famous French two-factor model that came out in the early 90s indicated that small cap tends to outperform over big cap over time. Value tends to outperform over growth over time. Is there additional evidence now of a third factor, this profitability factor? I don't know if you want to call it quality or whatever we have come to call it, is also another factor to consider. And then how do you layer that all in, these three factors, into your investment portfolio?
So you got it there, Bob. It is indeed another factor. It is an explanatory variable when it comes to explaining differences in returns across stocks. So you can think about size, value, profitability, and the fourth one, in fact, is investment, so asset growth. So how you can think about those types of strategies, Bob, is focusing on the stocks with the highest profitability in the marketplace, and how you think about layering it in then is you overweight those stocks that have high profitability, but are also value and also a little bit smaller cap within that high profitability segment, and those, we believe, have the highest expected returns among the high profitability stocks. So thank you, Nate, for the kind words there. We have been, I would say in the lowest Morningstar decile when it comes to our fees for a long period of time. And we were very cognizant when we entered the ETF market that for similar services, similar asset allocation, we had to have similar management fee across mutual funds or ETFs. So hopefully we got that right, and we've had quite a bit of success in the first 12 months with the conversions and so on. As Nate mentioned, we're knocking on that top 10 door with 10 more to come. And they're largely driven by the demand from the financial professionals. Nate mentioned the advisors that we work with and the network of advisors that we're a part of. They've been really happy with what we've done in the first year since launching ETFs and want 10 more for 2022. So we hope to be able to bring those to the market over the course of next year.
And explain what high profitability means. Does it mean high profits as a percentage of total revenues, or does it mean you're growing your profits every year? And can you get high profitability with value, or is that a contradiction in terms?
You can get high profitability with value, and in fact, in our value strategies or in our core strategies, we overweight those stocks that have the lowest relative price and the highest profitability. Broadly speaking, how to think about it, Bob, is that you take revenue, subtract off some measure of cost, so maybe you get to operating profits or something similar, and then you can scale it by book value or assets. And when you do that, you get to a scaled version of profitability that then you can compare across firms. So you can look at one firm's profitability relative to another firm's profitability, even if one firm tends to be a lot bigger than another firm because you're scaling it by assets or book value. So that's how you compute profitability.
But it's not just profitability that month, it's that quarter. Are you looking at future expectations of profitability, of growing it more? I'm trying to figure out I know you're taking revenues, then you have a cost of goods sold in there, and you're figuring out some line of profitability, but is there expectations for future growth taken into this?
Yeah, the reason that profitability tells you something about expected returns, Bob, is that it predicts future profitability. And that's true if you take the profitability over the past 12 months, or if you take changes in profitability, so profitability growth over the past 12 months. Both of those predict future profitability, or more precisely predict which firms will have high profitability relative to other firms in the future. And so we use it as a stand-in for expected profitability, or one component of the expected cash flows to shareholders that a stock may generate on behalf of its investors.
Okay, now Gerard, I'm going to change the subject slightly. You have built out your own center for separately managed accounts to make customization, I guess you call it, more available to more investors at scale. Of course, separately managed accounts are just individual accounts that you can charge fees on, wrap fees or whatever. How does that work in practice? What are you actually doing here?
So we've been doing SMAs, or tax managed SMAs, for a long time, but recently with technology and all those types of innovations, we were able to lower our minimum from $20 million to $500,000. Effectively, in an SMA, what you can think about happening is that an individual owns the stocks directly in their own custodial account, and that means they can express their values, whatever those values may be, by excluding, underweighting, or overweighting certain stocks. They can also manage towards their tax situation. In an ETF or a mutual fund, it's a commingle strategy. Everybody's in it together. If it's your own account, you can manage specifically towards your tax circumstances. And so those are the two big reasons why some investors like a separately managed account, is tax management and then being able to express their values about what companies they want to invest in more precisely. So we launched that, a version of that we've been doing for a long time, back in September, and it's going well so far. And I think that it could potentially be the future of investing, to stand alongside mutual funds and ETFs as technology enables the cost of delivering customized SMAs to individuals. It drives that down and has done over time.
Yeah, it's kind of remarkable. What do you think of this, Nate? Can you do institutional level management on a personal investor level? I mean, I know Gerard is not trying to be a financial advisor to individuals here, but he's trying to make this available to financial advisors. Can you build a totally customized stock portfolio on on an individual a level and still have it on an institutional size? It seems like you're trying to ask for a lot.
Yeah, from my perspective, this will be another tool in the advisor's toolbox. And the fact is, going to commission-free trading and the fact that those costs have come down, fractional shares, those sorts of advancements have made what I refer to as direct indexing or custom indexing much more viable to the mass retail investor. And I do think there are certain situations where it makes a lot of sense. If you have an individual who, let's say, works at a particular publicly traded company and they have a large allocation to that company's shares, they don't want to double down by holding those same shares in a broad index. Or perhaps you have a higher net worth investor where taxes are a big consideration. They have a lot of taxable investment money. Direct indexing can make sense because you can tax loss harvest at the individual level. I think if you had an investor with very strong ESG considerations, direct indexing can make a lot of sense. So I think there are use cases where it will be very valuable to the end investor. But I see this, to Gerard's point, is sitting alongside the other vehicles that exist. I don't see this as overtaking, for instance, exchange-traded funds.
Yeah, that makes a lot of sense. Okay, gentlemen, I'm going to have to leave it there. That does it for this week's ETF. My ETF Edge. My thanks to Gerard and Nate. We've asked Nate to stick around to chat a little bit more about ETFs in 2022, what's coming up, his thoughts on our ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.